Wait another minute, actually. Okay. Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Winter Webinar Series. This program is entitled The Intersection of Elder Care Planning and Estate Tax Planning, where Medicaid and estate planning meet and diverge. For those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients to achieve their financial objectives. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One more quick note before I introduce our esteemed speaker, and that is that the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Elizabeth Forspan, managing attorney at Forspan Klear based in Long Island, New York. Elizabeth practices in the areas of elder law, trust and estates, and taxation. She regularly assists clients in achieving their Medicaid planning goals in a tax-efficient manner through practical and considerate planning techniques. Elizabeth speaks throughout the United States on various aspects of elder care planning, tax law, and estate planning. She has been featured in New York Magazine, MarketWatch, and has been quoted in the New York Times. Prior to co-founding Forspan Klear, Elizabeth was the managing attorney of a leading elder law and trust and estates law firm. She also served as a tax manager with Ernst & Young. On a personal note, I've had the privilege of collaborating with Elizabeth on client matters, panel discussions, speeches, and co-authoring articles. She's undoubtedly one of the top practitioners in her field, and I'm very pleased that she could join us today. Today, Elizabeth will be speaking on the intersection of elder care planning and estate planning, where Medicaid and estate planning meet and diverge. And with that introduction, I'll now turn the program over to Elizabeth.
Okay, Jonathan, thank you so much. And thank you all for being here. It's an honor, as always, to be with you and with our esteemed what can I call Jonathan? He's just, there's nothing really, no words to describe Jonathan. He's really the best. Our great leader over here and one of the most incredible practitioners that I've met. So it's really a pleasure. Today, we're going to go very quickly. We have another 28 minutes, so I'm not going to waste a lot of time like I normally do. So as Jonathan mentioned, we're talking about the intersection of elder care planning and estate tax planning. And this is an important topic because I find often that there are, many people who engage in elder care planning, Medicaid planning, and they don't give proper consideration to the income tax and estate and potential estate tax implications. And so what we wanted to do today was touch upon that, where those considerations really diverge and meet, of course, and how when we design an elder care plan, an effective elder care plan or a Medicaid plan, whatever you want to call it, we must consider the income tax considerations and the estate planning considerations and the estate tax considerations. So that's really what we're going to talk about today. Many of you will be very familiar with the topic, and some of you will be very surprised about the types of things that we need to consider as we engage in elder care planning for our clients and for our loved ones. All righty. So let's get into this. Just a very, very brief Medicaid overview. So when we're talking about elder care planning, typically what we're talking about is paying for the cost of long-term care. How do we plan for our clients and our loved ones and for ourselves, where when we get older and where we require care, we will have sufficient funds to pay for it? Now, there's the idea of long-term care insurance. There's the idea of reverse mortgages. We're not going to get into that today. What we're going to be talking about is people who are engaged in Medicaid planning, right? Divesting yourself and your loved ones and your clients of their assets so that at some point in the future, they will be able to qualify for Medicaid, okay? Why do we need to do that? Why do we need to divest ourselves of our assets in order to qualify for Medicaid? Well, the answer is very simple, right? Medicaid will pay for long-term care, right? It'll pay for a nursing home. It'll pay for home care, or some of home care. But it's a means-tested government program, right? We can't be rich and get onto Medicaid. So in order to qualify for Medicaid in New York, the Medicaid asset rule in New York, the asset limitation right now, starting just 2 days ago, is $28,134, right? So an individual can have no more than $28,134 in countable assets, or what we call non-exempt assets. That's in New York. In other states, the number is far lower. In most states, the number is actually $2,000. It's tracked to the SSI, the Supplemental Security Income level of $2,000 in total assets, okay? But in New York, we live in we're in a very generous state here, or the most generous Medicaid state in our entire union. I say that all the time. And the asset threshold is $28,134. Now, certain assets are exempt, right? So in New York, a qualified retirement account is an exempt resource, believe it or not, as long as it's in payout status. And I'm not going to get into what payout status means, but in essence, what you need to understand is that you can have a retirement account with a qualified retirement account, an IRA or a 403B or a 401k with $500,000 in it or $1 million in it. And as long as it's in payout status, according to Medicaid, what Medicaid considers payout status, which is not necessarily required minimum distributions, as long as it's in payout status, it's considered an exempt resource. Also, there are certain times where your home is considered an exempt resource also and not counted towards that $28,000 number. So that's very important to note. We're actually going to talk a lot about the home in just a few slides. So you can have no more than $28,134. So what does that mean? That means that people need to divest themselves of their assets. They need to, quote unquote, get rid of their assets in order to qualify for Medicaid in the future. And I say in the future because we have something called a look back, which I'm going to talk about on just the next slide. Now, we also need to consider that there are income rules with Medicaid, which we're not going to get into too much today, but suffice it to say that when we do our Medicaid planning and we gift away assets or we transfer assets, we need to work with a financial advisor, someone like Jonathan, to say, hey, I'm getting rid of my assets, but when I get rid of assets, am I also getting rid of the income that attaches to that asset, those assets, right? I may be 67 years old and I'm engaging in this Medicaid planning, which is about the right time to do it because of the 5-year look back. I may be 67 years old and I'm getting rid of these assets. I'm putting them in a trust, but does the trust give me income? Can my trustee give me income? Well, we need to talk about what that does from a Medicaid perspective and what that does from a financial perspective. You may still you're putting a brokerage account, let's say, into a trust. You may still need that income to live on, but then in 20 years from now or in 10 years from now, when you need Medicaid, the fact that the trust allows for you to have that income, what does that do to your Medicaid? Well, in New York, not that much if you're getting home care because we have something called a pooled income trust, which really allows us to deal with excess income. But if you're in a nursing home and you have high income, well, that's not great, right? Because in the nursing home, you're only allowed to keep about $50 a month in income, right? That's not all that much. The rest of it, your income has to go to the nursing home. And then Medicaid, of course, picks up the rest. So it's very, very important not only to consider the tax considerations, which we're going to talk about at length today, well, in 22 minutes worth of time, but also to consider the financial considerations. I always say that you cannot engage in an effective Medicaid plan unless you are also working together with a financial advisor. As an attorney, I can't tell my client, okay, take all this income off the table. You don't need it. I don't know that. I don't know what their assets are. I don't know what their expenses are. I don't know what their projected income is going to be like over the next number of years. I don't know what their accounts are throwing off, right? I'm just a lawyer, right? What does a lawyer know? Not much. So we must work together with a financial advisor. Very, very important when we design what we want to be an effective Medicaid plan for our clients. Okay. Now, I also want you all to be aware of something called spousal refusal. Spousal refusal is where, let's say it's a last minute type of thing. They did not do any planning. The clients have not done any planning, but they're lucky to have that there are two spouses. Well, one of the spouses that needs Medicaid, we call that the Medicaid spouse, can in essence transfer all their money to the non-Medicaid spouse, what we refer to as the healthy spouse or the community spouse. And the community spouse, Medicaid says, well, we look at the total assets of the couple. Yes, but there's something called a spousal refusal where the a healthy spouse, the non-Medicaid spouse, could basically say, I sign a document and say, I am refusing to pay for the cost of care. And so that is not a barrier to eligibility. The Medicaid spouse will get onto Medicaid. Now, does that completely let everybody off the hook? No, there's still the chance of a spousal lawsuit. Medicaid can go and say to the refusing spouse, hey, you owe us something. That hasn't happened in a very long time. For most of my colleagues have not seen a spousal suit in a very long time, particularly during the pandemic. However, it can happen. But even if it does happen, even if Medicaid comes back to the refusing spouse or the healthy spouse and says, you owe us something, what that spouse is going to have to pay towards the cost of care is far, far, far less than what the private cost of care would be. Okay, so spousal refusal still exists in New York. Again, it's state specific as to whether the spousal refusal works and how it works. So we have to take a look at that if we're outside of New York. Okay, now we're going to talk about the 5-year look back. Okay, the 5-year look back means I can't just transfer my assets today and get onto Medicaid tomorrow, right? No, that doesn't work, right? If I'm in a nursing home or if I have a loved one in a nursing home, even if I have no money, I'm under the $28,000 asset threshold, Medicaid is going to look to see if I have made any transfers within the last 5 years. And this is going to be very relevant when we talk about the annual gift tax exemption, because these are two very different things, okay? So Medicaid's going to say, hey, you have no money today, but during the past 5 years, during the past 60 months, you transferred assets. You made non-exempt transfers. We're going to count that as if you still have that money. And on the next slide, I'm going to say how I'm going to explain how they calculate that. Now, they've also tried to impose a 30-month look back for home care, a 2.5-year look back for home care, which came about during the pandemic. However, it is not effective yet. They keep pushing it and pushing it and pushing it. So right now in New York, very important, in New York, there is currently no look back for home care. What does that mean? On January 31st, I can transfer all of my assets, get under that $28,000 threshold of non-exempt resources. And then on February 1st, I can apply for Medicaid. I'll be eligible for Medicaid. Okay. Now, April 1st, 2024 is the date that we are now working with, that the 2.5-year look back is going to apply. So listen, the gravy train is coming to an end. I have to be honest with everybody, right? We used to just say, okay, I'm not going to do any Medicaid planning, although that was a stupid thing to say because you could still end up in a nursing home where there was a 5-year look back for many, many years. But people used to say, I'm never going to a nursing home, as if they have a crystal ball. A lot of us do, I know. I'm never going into a nursing home. If I need home care, I'll just transfer my assets the month before. Doesn't work anymore. If there's going to be a look back for home care, we now have to really, really consider doing this planning in advance. Okay. I mean, we should have always been doing it in advance, but I have a new client. The husband is 101 years old. The wife is 94. And I'm talking to them about the trust and how if one has to go into a nursing home, we have to revoke the trust, etc. Even an irrevocable trust can be revoked if it's drafted properly. And they're like, why we have to do that? I said, listen, had you come to me 30 years ago when you should have, although I would have been in 3rd grade, but had you come to me 30 years ago, we did this planning when you were in your 60s, when you should have done it, then all of this would have worked out beautifully and we could have tied it up with a nice bow. But now that your dad's 101 and your mom is 94 years old, it's not going to work so easily. Should we still do the planning? Of course we still do the planning, because from a home care perspective, putting the house in the trust and putting the assets in the trust works beautifully. Okay. Now, for every asset, in New York City, for every 13 or 14, now it's 14,000. For every $14,000 that you transfer in the last 5 years, that's 1 month of ineligibility, right? So let's say I transferred $140,000 within the last 5 years. That is 10 months of Medicaid ineligibility in the nursing home. If I apply for a nursing home today, what does that mean? I'll have to pay privately for 10 months. Then after the 10 months, Medicaid will kick in. That's how the penalty works for nursing home. For every about $14,000 that you've transferred within the last 5 years, 1 month of ineligibility, 1 month you have to pay privately. Now, that is going to be the same way so far as we know, when the home care look back kicks in, the 2.5-year look back kicks in for home care, that's how it's going to work as well. Okay. Now, let's talk about why we're here. Some of the tax issues associated in the Medicaid planning, and these are huge, okay? So we're going to talk about the tax implications of making outright transfers versus making transfers to trusts. We're going to talk about transferring real property. We're going to talk about transferring liquid assets, brokerage accounts, etc. And of course, we're going to have a very heavy emphasis on the basis issues. Okay, so I'm not talking about the non-tax issues, creditor issues, parentheses, the child getting divorced, why it's a very bad idea in general to transfer assets outright to a child. What I want to focus on is the income tax considerations and the capital gains tax considerations, okay? So the question is, you're engaging in Medicaid planning, you got to get rid of assets because you want to one day qualify for Medicaid. Should you put it in a trust or should you give it to your children? Well, almost 99% of the time, what are you going to do? Of course, you're going to put it into a trust, okay? I hate to give it away, but since we have so little time, I'm just going to give it away. You're going to put it into what's called an irrevocable trust. Now, these irrevocable trusts, which I'm going to talk about on a further slide, are not the typical irrevocable trust that those of us in the trust and estates world think of, those of us in the estate tax planning world think of. See, I have a very weird position. I have my feet or my toes dipped in both worlds. I'm a tax lawyer and I'm a Medicaid lawyer, okay? And so, but most people don't have that. And that's why it's very, very important that if you're a Medicaid lawyer, if you're an elder care lawyer, you understand the tax considerations. If you're an estate tax lawyer, you got to understand the Medicaid considerations, right? Because they don't always work well together. In fact, they often do not work well together, but there's a way to do this, okay? So if we transfer assets outright to a child, what are we doing? Or anybody else, what are we doing? We're giving a carryover basis. Our basis in the asset is now going to carry over to the recipient of the gift, right? What we paid for the asset, our cost in the asset is going to transfer over to the recipient. So I'm going to give a crazy example. Nobody would do this, I'm sure, although I've seen it a bunch of times, right? You have a house. You have a house in Flushing. You have a house on Ocean Parkway in Brooklyn. You bought the house for $50,000, okay? In 1978, you bought it for 50 grand. You didn't put anything into the house, right? Your basis is $50,000, let's say, okay? The house is now worth $1.5 million. This is a reality, folks. I mean, so many of our parents and our grandparents and our clients have this reality that they're living in right now, right? Your basis is $50,000. The house is worth $1.5 million. If you say, listen, I got to get rid of this house. It's not going to be good for Medicaid. I want to qualify for Medicaid. Let me give it to my son. Okay, you give it to your son. You don't do a life estate, nothing like that. You don't put it into a trust. What have you done? Something really stupid, right? We just did something really, really stupid because we now just gave her over a carryover basis. So when we die, we didn't own it, so we don't get the basis step up, right? The basis step up is when you die, if you own an asset, the new cost basis is the fair market value on the date of your death. No, what you've given them is what you paid for it in 1977, and you haven't put anything into it, so it's a $50,000 basis. That's what you're giving your son. So whenever he sells it, if he sells it now, if he sells it later, if he sells it when it's $3 million, he's going to have a gigantic, gigantic capital gain. So that works with stock also, right? You bought this Apple stock back in the 1980s. You have this Con Edison stock that you inherited in 1968 from your mom, and that you have very, very, very low cost basis, right? We can't own those assets because we need to get onto Medicaid. We got to transfer those assets. Should we give those assets directly to our children? Of course not, because what we are giving them is the carryover basis. Whatever our adjusted basis is, that's what we're going to be giving to our children or whomever we're making these outright gifts to. So almost 0% of the time do we want to transfer assets outright. Instead, what we want to do is we want to transfer it to a trust where we can get the basis step up, right? There is a way to transfer assets to an irrevocable trust and still get a basis step up. Now, many of the estate tax practitioners on the line, or the tax practitioners on the line, they're going to say, Elizabeth, you don't know what you're talking about. When you transfer assets to an irrevocable trust, it's a completed gift, right? Not always. Most of the time, when we're doing estate tax planning, of course, we're doing irrevocable trust. We want to get the assets out of the estate, so we make a completed gift. We don't want to have any strings of ownership under Section 2036 or Section 2038. We don't want to bring it back into the estate. The whole purpose in the estate tax world, often when we do the irrevocable trust, is to get the asset out of the estate. But folks, when we're talking about Medicaid, we generally are transferring these low basis assets. We're not worried about clients who are going to have a taxable estate, right? I don't know if we're going to get to the slide, but we all know that the estate tax exemption is so high. It's over $12.9 million on the federal level, $6.5 million in New York. Most people that we're doing Medicaid planning for do not have to worry about an estate tax, okay? Although it's not true 100% of the time, which is why we need to design it in a very particular way. So there is a way to do an irrevocable trust, to draft an irrevocable trust that where the assets are going to be considered an incomplete gift from an estate and gift tax perspective, meaning the assets will still be brought back into taxable state, will still get a basis step up. But from a Medicaid perspective, it's a completed gift, okay? How do we do this? Okay, there's something what I like to call an irrevocable Medicaid asset preservation trust. Some people call it Medicaid asset protection trust. That's a misnomer because the grantor does not really get the traditional type of asset protection that you would think about, and there's a reason for it, okay? Now, in order for the trust to work from a Medicaid perspective, it needs to be an irrevocable trust. The settlor, meaning the grantor, should not be the trustee. It's best practice for them not to. I would never have the grantor be the trustee. Why? Because if the trustee has any sort of discretion, it's going to be a big problem. Medicaid is going to say this is a no-go, okay? Now, any income that's allowed to be distributed, if income is allowed to be distributed to the grantor, the entire income is considered that the owned by the grantor. That's fine in certain cases. I would say about 15 to 25% of the case, I actually do give some of the income to the grantor. But again, remember what we talked about earlier. If we're doing a trust, we're transferring assets to a trust, and we have to make a decision. Do we let the trustee give income back to the grantor, or do we let the income sit in the trust or have it be distributed to beneficiaries? We have to talk to the financial advisor, someone like I call him Yoni, someone like Jonathan, in order to make sure we know what we're doing, okay? And we're planning for the future, not just from a Medicaid perspective, but also from a financial planning perspective for our clients. You got to work together with the financial advisor. Principal cannot be distributed. The trust cannot allow for any principal distribution to the grantor or the settlor. If the trust allows for any principal distribution, if it allows for trustee discretion to distribute principal to the grantor, the entire principal is going to be viewed by Medicaid as an available asset, okay? So let's say you do a trust and then it has a HEMS provision. The trustee can HEMS, health, education, maintenance, and support, an ascertainable standard. We're very familiar with that, right? I'm giving the asset to a trust. The trustee can give me back money for my health, education, maintenance, and support. Is that good? No. Medicaid says it's bad. Very, very bad. The entire asset, the entire principal of the trust is viewed as an available asset to the grantor. Not only that, but if you do it and you have health, education, maintenance, and support income or principal for health, education, maintenance, and support available and allowed to be distributed to the spouse of the grantor, that is also a problem. The entire trust is going to be viewed by Medicaid as an available asset. That's why it's very important. We're going to talk about this if we have time with regard to a credit shelter trust, right? So many of us see with our clients and with our loved ones that one spouse died, and in his will, he left what's called a credit shelter trust for his spouse, let's say his wife in this case, okay? And what does the trust in his will say? The money goes into the trust. It's for my wife's benefit. She gets all the income from the trust, and she can access the principal also subject to an ascertainable standard, health, education, maintenance, and support. Guess what, folks? Medicaid is going to say that entire trust, the entire credit shelter trust under the deceased spouse's will is going to be an available asset for the surviving spouse. Therefore, the surviving spouse is going to be ineligible for Medicaid. This is where estate planning and Medicaid planning diverge. Okay, so we need to be we have to be very considerate when we talk about these issues. Okay, HEM standard, no good for Medicaid. Okay, now what type of assets can we transfer to a trust? Virtually everything other than a retirement account. Let's just put it that way. You could put a house in a trust. You could put a brokerage account in a trust. Can you put an annuity in the trust? You could put a non-qualified annuity in the trust. I have a slide on this, right? Some people are going to say, wait, Elizabeth, isn't there code section 72? If you transfer an annuity, actually, let me put up that slide now and I'll come back to 121, right? If you transfer an annuity contract to somebody or to a trust, typically if you transfer it to an irrevocable trust, then all the deferred income is now going to be includable in your taxable income, right? You're going to get a huge whopping 1099. The answer is no. If you transfer an annuity contract to a grantor trust, right? We have to look at our legislative history. We have to look at numerous private letter rulings. If you transfer a non-qualified annuity into a grantor trust, right? I'm the annuitant. I transfer it into grantor trust. I'm the grantor. It is not considered a transfer. The annuity contract can remain tax deferred. A lot of people don't know this. A lot of elder care attorneys don't know this. A non-qualified annuity from a Medicaid perspective, you can't keep it in your name, right? It's considered an available asset. It's not a qualified annuity in a retirement account. I'm talking about a non-qualified annuity. That is considered an available asset. So many elder care attorneys tell their clients, okay, cash it in. Cash it in. We know so many of our clients who have these annuities, there's a lot of built-in income there. If you cash that baby in, what's going to happen? You're going to get this big whopping 1099. Nobody wants that. And also, what are you going to do with the cash? No, you transfer it to an irrevocable trust. That's a grantor trust, but you got to be very, very, very careful in how you draft the trust. And in fact, in most cases, when people transfer an annuity to a trust, they make sure that the spouses have two separate trusts. I'm not going to get into it today. Please call me. Everybody knows. Everybody who's ever heard me lecture, I always give out my email address. It's on the first slide and the last slide, and my phone number is there also. I try to answer every single question. I welcome it. I love that stuff. So please email me. Annuity contracts, non-qualified annuities can go into a grantor trust. Okay, let's move back. Why do we want a trust rather than a transfer, an outright transfer? Section 121 of the code. We have to be very careful with this, right? We know that when we sell our principal residence, as long as we have lived there for 2 out of the last 5 years, what are we entitled to under Section 121A? We're entitled to a $250,000 exclusion from capital gain. Remember the example I gave earlier with the house that we bought for $50,000, but it's now worth $1.5 million, which is a reality, right? We need that $250,000 exclusion, or in the case of a married couple, a $500,000 exemption, right? If they're joint filers, they don't have to both be owners as long as they have both lived there and they're joint filers on the income tax return. So we need the $500,000 exemption. We need the $500 exclusion because we wipe out a lot of capital gain. But you're going to say to me, Elizabeth, if I transfer my house into a trust, can I still maintain the Section 121A exemption? The answer is yes. Yes, if you have the ability to live in your house for the rest of your life, which is totally fine from a Medicaid perspective, right? You're living there for 2 out of the last 5 years. It's a grantor trust, folks. You can still get the $250,000 exemption from gain. But if you transfer your house to your children, you're not getting the $250,000 exemption from gain because you're no longer the owner. What if you transfer it subject to a life estate, right? That's where you transfer the remainder interest in the home to your children. You transfer the home to your children with the ability to live there for the rest of your life. Of course, you're entitled to the 121A exemption, but the value of your life estate is not $250,000, right? The value of your life estate based on the IRS's tables, depending on your age and the value of the house, maybe it's $50,000, maybe it's $70,000. So the exclusion from gain is going to be limited to the value of your life estate, right? So the Section 121A exemption, the $250,000 or the $500,000 exemption, you're really giving up a lot if you do a transfer of your home subject to a life estate. Also, your children are not going to be able to get the $250,000 exemption, even though they're owners and they meet that requirement of Section 121A. What don't they meet? The residency requirements, having lived there for 2 out of the last 5 years, right? So transfer it to a trust. You have the ability to live in the trust, the ability to live in the house for the remainder of your life. It's a grantor trust. You and your spouse are entitled each to the $250,000 exemption if the house is sold during your life. Okay, I'm not going to go further into Section 121. Now, transferring a brokerage, liquid assets into a trust, right? Very important. Again, most of these trusts are going to have estate inclusion. Now, I didn't really talk about what that means, okay? And I'm going to talk about that right now. What gets us estate inclusion, right? We have to be very careful when we draft these irrevocable Medicaid qualifying trusts, these Medicaid asset preservation trusts, to maintain a situation where we're going to have estate inclusion and a basis step up, okay? How do we do that? We include the ability for the grantor to receive income from the trust, right? Under Section 2036, we know if you give away an asset, but you retain the right to the income, the strings of ownership, the incidents of ownership, the asset is going to receive a basis step up when you die because it's going to be part of your taxable estate. But you're going to say, Elizabeth, you just told me in most cases you don't give the income to the grantor. So what do? Instead, we include something called a limited power of appointment, the ability to, on a limited basis, change the beneficiaries of the trust. The grantor has the ability to change the beneficiary of the trust. Well, Medicaid says that's okay. The estate tax world says that's not okay. If you have a limited power of appointment, if you have the ability to change the beneficiaries of the trust by will, inter vivos, we're not going to talk about the difference in that. today, but I'm happy to talk about it later, then potentially the estate tax people are going to say, hey, that's a state inclusion. Exactly. That's a state inclusion. That's what we want in these cases, right? We don't want to think about not having that limited power of appointment. We want to think about having the power of appointment. And on a related note, by the way, having the power of appointment is actually what would allow the trust to ultimately be revoked if it needs to be. What? Revoke an irrevocable trust? How is that possible, right? Is that possible? It is possible, but everything has to align. The trust has to be drafted properly. In order to be able to revoke an irrevocable trust, typically you're going to need to have a limited power of appointment, because under EPTL 7-1.9, which is our revocation statute, the grantor needs to have the consent of the beneficiaries of a trust in order to revoke the trust. Well, how do they get the consent of minor beneficiaries? You can't do that, right? If you're under the age of 18, or even a minor contingent beneficiary under the age of 18, under majority age, they can't give consent. So if you have a limited power of appointment, you could change the beneficiaries of the trust, change it to just one adult beneficiary, and then under 7-1.9, all you need is the consent of that one adult beneficiary. Now, why would you ever need to revoke a trust from a Medicaid perspective? Well, remember the example I gave of my 101-year-old client, right? Transfers the assets to a trust, but then he needs to go into a nursing home within the 5 years. So Medicaid says, hey, you've made transfers within the last 5 years. You need to revoke the trust, get the money back to you, and then you can do the last minute planning, the rule of halves we're not going to go into. I have like 1 minute left. In fact, I don't even have that 1 minute. But what I want to talk about is, what I just want to mention in this last minute is income taxes. Who pays the income taxes on these trusts? Generally speaking, these are grantor trusts, even if the grantor is not receiving the income, right? It could be a grantor trust because you have a limited power of appointment, or you give a swapping provision, right? The ability for the grantor to swap in and out assets of equal value, right? We want to look at section 672 through 678 of the Internal Revenue Code. There's a couple of things in there where we could throw into these trusts to make it a grantor trust, right? So you almost always want the income taxes not to be paid by the trust. Of course, we almost never want income taxes to be paid by the trust at their accelerated brackets, but we want the income taxes, even though the grantor is not receiving the income, we want the grantor to pay the income taxes because A, it's at a lower rate, right? And B, when the grantor is paying the income taxes, he or she or they are further reducing the assets that they have that are outside the trust, which is only going to help us for Medicaid, because for Medicaid, we have to have our assets low. Okay. Estate taxes. Do people who engage in Medicaid planning generally need to worry about estate taxes? Generally not, but sometimes they do. And sometimes we need, where there are some assets that don't throw off a lot of income that have really appreciated. Sometimes what we need to do is bifurcate it. We need to put some of the assets in a trust that where it's an incomplete gift, which is what we're talking about today, right? Where it's going to receive the basis step up and it's going to have a state inclusion. And maybe we gift away some of the assets to a trust where it's going to be a completed gift. Okay. Real estate tax exemptions, we want to maintain the veterans exemption, senior citizens exemption, enhanced star exemption, grantor trust, folks, we can do this, okay? Now, we obviously want to keep an eye on this, on the estate tax exemptions, which I already spoke about. Now, this is the last thing this is what I'm going to close with, okay? We know that the annual gift tax exemption, the amount that you can gift per donee is $17,000. Since the last 2 days ago, it's now $17,000 per person. You could gift $17,000 and you don't have to file a 709, a gift tax return. We all know that. You have 10 grandchildren, give $170,000. Okay, wonderful. If you're married, give $340,000. That's great. You don't have to file a gift tax return. So people say to me, well, I want to get onto Medicaid. I say, well, have you made any transfers within the last 5 years? And what do they say? Only the 16,000 or the 15,000, the gift tax exemption. Folks, it doesn't work for Medicaid. Medicaid considers that a transfer. Remember, we talked about for every $14,000 that you've transferred, that's 1 month of ineligibility. So Medicaid in most cases will count that as a transfer. That's where these rules really, one of the areas where these rules really diverge. So Medicaid typically in New York will look at all transfers of $2,000 and above. Okay, folks. So I just, these are great. These are good slides. You want to go through them, by all means. I welcome it. Just be careful about all of these issues. HEMS provisions, irrevocable trusts. What does that mean? 5x5 power for Medicaid, no good. No good. Revocable trusts for Medicaid generally, no good. I could talk about it on a different time when they are good. But these are some examples of when good estate planning equals bad Medicaid planning. But the moral of the story, folks, is that you could do it both. We could do them both together. but you got to look at, when you do the Medicaid planning, you got to look at the tax side. And when you do the tax planning, you got to look at the Medicaid side some of the times. Okay, folks. So what I'm going to do is I'm going to turn it back over to Jonathan. I'm going to say thank you all very much. Jonathan, thank you. I love doing this. I hope I had enough energy today, even though I didn't have my coffee. And I'm going to turn it back to you.
Great. Thanks so much, Elizabeth. You always have a tremendous amount of energy. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Elizabeth or myself where appropriate. And I'll be sure to include her contact information in a follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones that are served by a team of knowledgeable advisors. 3 more very quick items before I let you go. First, my winter webinar series continues on Tuesday, January 17th, featuring Connor Barth from Sterling Foundation Management. He'll be speaking on appreciated real estate opportunities for advisors. And I'll send out an invitation to this and all of my upcoming webinars after the program. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And finally, if you or a colleague would like to be kept abreast of my latest articles, webinars, or all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow my work on Twitter, YouTube, and Instagram. My handle is @ShenkmanOnMoney. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.